Thanks, sir. Much better. All right. So, Chris had asked a question. Glad you asked that question, Chris. So what happens if you have a lost or a 401k that gets left behind somewhere? What do you do with it? Or where is it at? How do you find it? So there's a bunch of resources that are available to locate that. So there's some addresses there. You can just do a Google search for I lost my 401k, and you will get most of these results here. Okay. Some of these are unclaimed.org is a database for unclaimed property. So that is a 50 search state. So if you 50 state search. So if you've been in more than one state, or lived in more than one state, or even worked in another state, because that's where you would be paid from, even if you lived, in Missouri, but say like if you're in the Kansas City area, you could work across the border. So that does change things there. This is a way to look for assets that are left in another state. The other ones are for retirement benefits themselves. So Department of Labor, so every company that creates a 401k has to do a filing with the federal government with that. They are also required by law to keep the 401k assets in this pocket and everything else in this pocket. So even if they go bankrupt or something like that, the 401k assets are supposed to legally be separated. Now, they may only contribute that on a quarterly basis, similar like your quarterly filings for taxes. So you might be out one quarter's worth, say the company goes under, and that last quarter, for whatever reason, did not get transferred out into that account. In theory, that could happen. But this is where you can actually search for the company. You'll get some information then about who is the 401k advisor, like what company they're dealing with, what they contracted with to manage that funds, and then you can do it. So what do you do once you found it? Or say that you left a job that had a 401k, and you got that 401k from company ABC, and you're now working for XYZ. What do? So you have a few options. You can roll a 401k over to an IRA. You can also roll it into your current 401k. Or you could leave it where it's at. Now, why would you want to leave it where it's at? Say that the mutual funds because every company, when they set up a 401k, they say, these are the mutual funds that you can invest in, and that's it. You're limited to what they're letting you do. Maybe those funds are actually very good as far as fees and expense ratios, which we'll talk a little bit about tonight. Maybe it'd be more financially advantageous to leave it there as far as what the fees are coming out of it. You say, okay, I'll leave it there. It's doing good, it's performing, and I don't have to pay anything. Maybe I'll leave it alone. However, one of the dangers of a 401k is what if they were investing the money back into themselves? So the 401k was actually buying, stock of the company, and if the company goes under, then so it's your 401k. So that is the danger of that. So maybe the company's still in existence, but you're like, look, I left them for a reason because they ain't going to be around much longer. You might want to get, maybe I don't want to leave it there. Maybe I want to move it completely, I just want to leave them behind completely and just get it all over somewhere else. So that's where you could roll it to a current 401k, or you can roll it over to an IRA. That is available. What don't you do? Do not cash it out. Because if you cash it out and you're not 59 and a half, what you going to do? Penalties and taxes. Yeah, you're going to pay taxes anyway, but you're going to pay those extra penalties. Pay a very high tax price at that point. So we don't want to cash it out. We can do a lot of other things with it instead. All right. Picking back up, we were in stocks when we stopped, so we'll just kind of highlight again what stocks. Security represents the ownership of a fraction of the issuing corporation. You are a shareholder if you own stock, and you get a proportion of the profits back if they pay a dividend out. Traded on a stock exchange. It's just a marketplace where stocks are bought and sold. And we talked about the New York Stock Exchange, NASDAQ, OTC, over-the-counter. And again, the warning about OTC is it is not regulated at the same level that the others are. Just because something that was sold over the OTC, over the market, over-the-counter, doesn't make it bad or high risk. It's an elevated risk, but buyer beware. Know what you're supposed to be doing, okay? Because there's a lot of weird stuff that does get sold OTC. Pink sheets or the pink stocks are one of those. Penny stocks are one of those. Extremely high risk. You can see literally 300-400% increases in a price, but it literally goes up 5 cents and it's not worth anything anyway. So, value stocks. Those are stocks who appear to be trading at a lower price relative to its fundamentals. These are larger companies typically, like a Walmart or something along that line. They don't need cash infusions to operate, and so they're usually going to pay out dividends. They're actually putting their cash back to the shareholders. Growth stocks, however, it's whose worth is in the future potential growth of the company. So that would be like a startup. You got in at the ground level, or maybe you invested in, say, an Amazon when it was just a bookstore. If you got in on the ground levels of Amazon, that would have been considered a growth stock at the time. And so they're going to keep that cash in-house to continue to pump back into themselves to invest. And they usually don't pay dividends because they don't have any cash to pay out. It's being rolled back in. Dividends, portion of this company's earnings they distribute back to shareholders. Does anybody need a sheet from last week? A review sheet. I think everybody here was here, so. Okay. Can be paid out as cash distributions, but it can also be reinvested back in. That's the DRIP plan, Dividend Reinvestment Plan. That allows you to not take the money out, but to leave it back in there, and it allows to buy more stock, and it just continues to grow and grow and grow, is the theory on that. Some companies do allow you, again, to buy dividends or buy stock with dividends at a reduced price. You will receive a 1099 for dividend distributions at tax time if it's not in a sheltered account, like a Roth IRA or something like that. 1099s, again, show up, though, for any time you get interest or anything like that. Or if you're a contract laborer, you get that as well. All right, so that is a stock price page. And Walmart. I was like, I don't even know what I grabbed. I just grabbed Walmart there because it's going to have a lot of things on there. So just kind of when you say you're interested in a particular stock or you just want to be curious, finance.yahoo.com is a great site. It's Yahoo's finance page. Google used to have a good one, but now it's terrible. So everybody just uses Yahoo. That's easy, quick. Finance.yahoo.com, you type in the company name or the symbol, and that works for funds, companies, whatever. And then you're going to get a page that looks like this. And so tons of information across the top. We're only going to look at basically this main page. But the first thing we look at, first thing we see way up at the top, that is the current price. So at close on July 28th, it was at $159.91. It said that it went up 75 cents that day, which was a gain of 40.47%. That's the previous close. It opened that morning when the stock market started at $159.29. So we have the bid and the ask prices. So there's a lot of information on here. So wait a minute, in the stock price $159.91? Yes and no. So the bid price is the price that somebody wants to pay for said stock. The ask price is what somebody wants to get. And so if it's very close, that means everything is smooth as far as the market goes, and it's easy to trade back and forth. Stock is just like any other thing. It's subject to, the normal effects of the open market. If there's lots of demand for something, what happens to the price? It goes up. If there's no demand, the price goes down. So if I get Walmart stock and I really want to get out of it, my asking price is probably going to be lower than possibly what the current price is. And it's going to be less than maybe a bid price because I want out. Now, if somebody says, I really want some Walmart stock because, man, I think it's going to go through the roof, I'm willing to pay, then the bid price is going to be higher. And so there's a difference that happens between those two, and that affects the volatility of it. Volume, that is how many shares were traded in that day. So there were 3.6 million shares of Walmart traded on July 28th. Okay. Average volume, that is the trailing 3 months. So they averaged 5.6 million shares. That was the average of what they've been doing. So this is a little under volume. So it wasn't quite as traded as quick. But we also see that our bid and our ask price are literally only a penny apart. So there wasn't a lot of give and take. It was just kind of a little bit of trading back and forth. So you didn't see quite the volume there. Market cap, that is how many shares of Walmart stock exists. 430.612 billion shares. So that is the total value of all the companies. Sorry, that is the total value of all the companies' shares of stock. So $430 billion worth of stock there. The beta, and again, these numbers you're probably not going to know or care. I didn't know all these things, okay? But it's still, you see this stuff up here, somebody throws a sheet out there, you're like, what is this? I don't know. At least now you can say, oh, I remember that. I looked at that one time. The beta, it's the measure of how the stock tracks with market volatility. Market volatility is the ups and downs, okay? So if it's a 1, that means it's basically matching the market. So if we were to overlay like an S&P 500 or a Dow Jones or something like that across here, if it was a 1, if the volatility, the beta was a 1, we'd actually see it would follow exactly the same, because that means it's matching the market volatility. If it's less than 1, it's less than the market. So where you might see there is, say, Walmart doesn't, say the stock market takes a spike, Walmart, because it's less volatile, it may not go up as much. Maybe it just even flatlines at that spot. If it's over 1, then it's going to be more volatile. So, you know, maybe the market's just chilling along here, and all of a sudden, whatever stock you guys are, boom, out of nowhere, that would be a more volatile stock. And it could go down as well. PE ratio, this one's a little more important. That is the price-earnings ratio. It is the stock price over earnings. It helps to determine over or under value of the stock. So we take the stock price, and we divide that by the earnings, which is not showing on here, but you can get that information in other areas, and then that tells you that it is 38.44 is its PE ratio. There are some rules that anything under 20 is good, anything over 20 is overvalued, but then again, you can't pick one thing and go with that because there's so many factors that factor into things. And then you also just have the current market conditions. Maybe, you know, none of those rules apply anymore because things are going on. EPS, earnings per share, that is the company's net income divided by total shares. It's where we get that, so that's earnings per share, so there we go, 4.16. So the money the company's made, divide that by the number of shares. Yes, and you're going to get your earnings per share on that. And then dividends, that's the big one. If you're into dividends, you are happy about that number. So our dividend is they are paying $2.28 per share of stock, or a 1.45%. Companies will state that their dividends will be paid out as a set value. So Walmart said we're going to pay out $2.28 on stock, per share of stock. That's what we're going to pay as a dividend. If the stock price is lower, then obviously that price is higher, or that percentage is higher. The number doesn't change. They'll set that every single year. Now, occasionally companies will do a special dividend. Walmart pays quarterly, but some companies will actually do they'll add a special dividend in. A few years ago, and Walmart was amongst several companies, the tax laws changed, and several companies, instead of paying their January dividend, they actually paid it before December 31st. Why? So they could take advantage of the current tax laws because it was going to be negatively impact their shareholders. They realized that if we pay this in, in January 1st, then our shareholders are going to have to pay extra on the taxes. And so they said, we're going to pay a little early. So they actually did 5 dividends as opposed to 4 that year. And then they only did 3 that next tax year. The ex-dividend date, that number right there, so that is the date in which they say, hey, you have to own the stock. If you own the stock by August 10th, you'll receive a dividend. If you don't, you won't get one. So if I bought the stock, and the dividend won't be paid out on the 10th. The dividend may not be paid until September 1st, say. So if I buy the stock on August 12th, September 1st, I don't get any dividend. Whoever I bought the stock from, though, they'll actually get my dividend because they were the owner of record on August 10th. So it is kind of good to know because that's going to affect the stock price. Because I'm more likely to want to buy a stock, the closer to that ex-dividend date, I'm more likely to want to buy it because I want to get that dividend. And so what do you think price is going to do? It's going to go up because it becomes more lucrative. The day after the dividend is actually paid out, then the price is going to go down on that. So that is something to keep in mind. The other stuff, this is a target estimate. This is stuff, you start getting into all this. This is people's opinions on what they think it's going to do. And then, of course, we have just a tax or a chart there. You can pick, that's a 1 day, 5, so on and so forth. And you can actually look at a long-term track on stock. I know a ton of information. Half of that you're probably like, I don't really care. But the point is, if you're doing any investing and somebody says, hey, why don't you invest? Man, Walmart's a great deal. You should invest in some Walmart stock. And they hand you pull up, you go to Yahoo Finance at yahoo.com, and you pull it up, and you find out that, man, this company is terrible. No, I'm not going to listen to them, Or realizing that, no, this thing doesn't pay any dividends, and that's what I want. I want that additional income coming in. So, any questions on that? I know that was a bunch of weird things. I've been playing with this stuff for 15 plus years, and some of this stuff is even a little foreign to me. So, mutual funds, because that's what most people are more familiar with, because that's what most have, 401ks, that kind of stuff. They're investing in mutual funds. What's a mutual fund? It's simply a basket of stocks and bonds. So it's as if somebody went and picked, and that's exactly what they do. They'll pick, hey, you know, I think Amazon looks good right now. I'll get me some Walmart, I'll get some AT&T, I'll get some, you know, so on and so forth, and I'm going to buy 10% of this and 5% of this. They put it all together, and then they call it, you know, Joe's Great Retirement Fund. Okay? So the fund manager buys and sells shares to increase the value of the fund and make returns for the investors. At least that is the goal. Returns values to shareholders by a long-term price increase, as well as dividends and capital gains. If you have mutual funds, you will get throughout the year, you may get a notice on there that says long-term capital gain payout, or a short-term, or a dividend payout. You should see those things. Capital gains, profits earned from the sale of capital assets. And that applies to other things, not just stocks and mutual funds. Okay? So if you sell a house for more than you paid for it, that is a capital gain. And guess what you pay taxes on? The capital gain amount. Yeah, exactly. Whether that's a mutual fund or a stock or real estate, doesn't matter what it is. You make money on it as a capital asset, that is a gain, and you'll be taxed on it. So if they're selling the stock at a profit, you're going to get that. However, the alternate of a capital gain would be a loss. Yeah, say you sold the stock and you had to, you lost money on it. That would be a capital loss, and you get to claim that. Some losses on your taxes. There's a bunch of rules in that, and those are set up to to help level out some of the market volatility, and so you can't claim a loss for a stock in this account and buy it in this account at the same time. If they happen within so many days of each other, they zero each other out, and you don't get to claim the tax loss on that. So they've figured out the loopholes in the system, and they've kind of blocked them off there. Any questions on that stuff, though, when it comes to your taxes, look at that. Talk to your accountant. Okay, they'll advise you on that, what you can claim, what you cannot claim, and then even how to help out, because capital gains can get expensive after a bit. So kind of help you out with that as well. Mutual funds, again, so they pay out the dividends. So those dividends are typically, as the stocks inside that mutual fund pay out dividends, then you get a share of whatever your share of the mutual fund is worth, you get a share of those. Same thing with capital gains. And I think I'll talk about long-term here in a bit. No, I'll mention that. All right, so here's one. Pioneer funds. Pioneer's been around forever and ever, in various flavors and things. This is one particular one. You're going to see a lot of the same things that you see on a stock report, because it's made up of stocks typically. So that's its current price. Now, you don't see any of the bids and the stuff like that, because mutual funds, the way they work is they don't settle till the end of the day. So when you buy a mutual fund, you're going to be buying it at $34.86 the next day. That's what you're going to buy it at. And so when you buy a mutual fund, you'll actually see it'll kind of be pending in your account until things settle. Because why? Well, it's made up. Remember, it's made up of all those individual stocks. And so for them to figure out how that all fits together, they got to wait till all those prices get finalized. Then they can finalize the price of the mutual fund, because it's built into that. So it takes a little bit for that to happen. Here's your year-to-date return. So for 23, it's been doing pretty dang good, 19.48%. Nothing to sneeze at there. The big number to consider anytime you're dealing with a mutual fund is that one right there, expense ratio. That is your fees. That's how much of your money gets paid to manage that, okay? These guys ain't doing it for a hobby. They're doing it to make money. And so they're going to receive, at the end of the year, they're going to pull out the net expense is just over 0.5%. For most mutual funds, anything under 1% is considered low or acceptable. When you start getting over 1%, that fund better be giving you some money. Because if you think about it, if you're getting an 8% return, but 1%, you're down to 7. And if you're at, say you're only getting 5% return, now you just dropped to 4. I can go to the bank and get that. So those are the things to keep in mind. Look at your expense ratios. How much of your money is getting burned up in fees? Holdings turnover, 57%. So that means that they are rotating things out. Half their stock has been replaced. So they have sold. I think Pioneer was maybe in kind of they used to be more of a holding phase, and now they're in a selling phase. Basically, they're taking advantage of what they think is maybe some higher prices. And so they're going to start selling some stuff off. And that's what you want to look at. If you're seeing a lot of turnover in that, that can be a little concerning because that means they're not hanging on to stock. The longer you hold on investment, typically the better the return it's going to make. Buying and selling, day trading works great on TV and in the movies, but there's a reason there's a high suicide rate in day traders. If you want to have some fun, read some of the posts on some of the internet, and I'll actually mention Reddit. Reddit is the wild, wild west of the internet. It is truly the wild, wild west of the internet. Buyer beware on that one. Not buyer, but viewer beware on Reddit. But there's some investing pages, and it's fascinating to get in there and read and watch these guys, and they'll post they may lose $300,000 in a day. And I'd be like, dude, no, I ain't, nuh-uh. So it's definitely something to watch out for on that. But the holdings turnover, if they're rotating them out pretty quick, it's not always the greatest deal. Holdings. Oh, sorry, there's another one. I just picked a second one there just to kind of illustrate something here in detail. You can see that's year-to-date return is 52.99%, so it's even better. 0.7% there, and its holdings is only 24%. So Pioneer's holdings. So this is the top 10 of their holdings. So this makes up 43% of their assets. Number 1 is Apple. 2 is Microsoft. Google said they are everything, so they became Alphabet, A to Z now. So kind of there is your top 3, and you can see the percentage that they're based up in. So they've got quite a diversified group of investments in this. But if you look at some of those names, and then I'm going to go to the next one here, you see some things here. Apple, Microsoft, NVIDIA. NVIDIA's right here on that one. So we're starting to see some copies of some things. One thing to keep in mind when you're looking at your mutual funds, you should look at your holdings. Because if you're trying to want to diversify your risk factor a little bit, and you're going to say, I'm going to buy into 4 different mutual funds, and then you're going to find out that all 4 of them's holdings are almost the same. Why? You're making extra paperwork for yourself. Just put it all in the one fund and be done with it. Because that's what's happening. That's effectively what you're doing. So it is good to look at that. If you are into more of the values, what they call morality investing and things like that, some of your holdings too is something to look at. The problem with doing that, if you feel strongly morally about that, and I'm not going to invest in stocks or anything that I would consider morally questionable. You look through that. Make sure you know where your line is, because it is extremely hard to be consistent in that. Because almost every company out there is going to support something you don't like. They're going to do that. Why? Because it's bad for business to tick people off. And Bev now figured that out. It's not a good idea. So they're gonna support groups and agencies that you don't like. And so if you're going to say, I'm not going to invest in that company because of that, check your whole portfolio, because I guarantee you somewhere in there somebody is doing that. So just look at that. And again, that's an individual decision you have to make on that. So an alternative to mutual funds, more of a newer thing, is an ETF, and it's an exchange-traded fund. And so basically you trade mutual funds like stocks. Because we now have the electronic means of everything we do, we can trade, we know the instantaneous stock price of anything at any moment, right? That's what we have. We have all this. Usually like your finance page, it'll tell you quotes are delayed by 15 minutes. So if you think that's the lie, if you're somehow trying to time the market down to the minute, you ain't doing it on finance.yahoo.com. You're at least 15 minutes off on that. So, but because we can track prices so quickly and we can consolidate all of it together, ETFs said, hey, there's no reason to wait for a whole day for everything to settle out. We can do it right now. And so that's what they do. So ETFs are going to be sold throughout the day. It's going to fluctuate, and so you'll actually see a day chart going up and down. Again, you're going to see the tax reporting issues the same as a stock or a mutual fund. If it's not in a tax-sheltered account, you will pay capital gains on that. But they have fees because, again, somebody's managing that. Sometimes the ETF fees can be quite hefty, so you need to look out for that. Again, I just picked one that had a bunch of stuff on here, information. You're starting to see more stuff back again like stock. There's your PE, your yield. Now we're back to bid and ask prices. Why? Because it's being traded like a stock. So we're not waiting for that day-to-day thing to settle out. And then that one I think I picked max, and so you can see it. The other cool thing is, say you're looking for a similar investment over here on the side, because perhaps, especially mutual funds, perhaps your broker doesn't offer that particular fund because Vanguard says we're only going to sell to Vanguard, and somebody else says I'm only going to sell to so-and-so, and you've got to pay us money to be able to sell our stuff. You can find something similar over here. So again, it gives you a lot of, you can shop it a little bit there. And then here's our expense ratio. That one's only 0.38%, so relatively low. And again, you can view the holdings on that one. And so there's the holdings in that group there. And note, the top 10 only make up 18%, so they've got a huge portfolio built into this one investment here. REITs, Real Estate Investment Trust. It's an alternative physical real estate because what most people tell you, what is a great investment? Real estate, you know? But being a landlord isn't always the easiest thing in the world, and real estate's expensive. And there's a lot of things that go into it. A REIT says, hey, we're going to give you all the benefits of owning real estate, and you don't actually have to own real estate. So it's an alternative there. You're going to invest in a company that's owning and managing real estate. So basically, you're just hiring some big person to be a real estate manager for you of property you don't physically have to own. They usually pay out large dividends. They have some tax rules they have to follow. Usually paying out, I believe it's 90% of their profits have to be returned back as a dividend. So it can have the potential of being extremely lucrative. However, you are at that point, because you're in the real estate market, understand you are at the mercy then of the real estate market. If it's going up or down. And the other thing you want to look at is on a REIT is how much debt does that company have? You know, if they're buying all this real estate in debt and the market tanks, your investment's tanking too, especially when they go under because they can't afford their mortgages. Because there's no return on a foreclosure. So that's definitely something to look into. Because of those large dividends, it's best paired with a tax advantage account, a Roth IRA, or something like that, so you're not having to pay those large capital gains fees on that. Fringe products. Number one, everybody wants some Bitcoin, right? Well, crypto. Options investing, I'll go back. Cryptocurrency. So there's all types of flavors and varieties. We do not have time to explain how crypto works, nor do I entirely know how crypto works. I like the concept of cryptocurrency. I like cryptocurrency. I do not have any cryptocurrency. But I don't like it as an investment. None of these things what I view as investments, okay? I will view them as, if you want to call it, maybe it's cliche or advertising, hedge against inflation. That's what you hear all the time. I would simply view them as they're something stable. Or not, I shouldn't say stable. Cryptocurrency I wouldn't call stable. It's an alternative. I like the cryptocurrency aspect from a political as a libertarian because the government has no control over it, or very minimal control over it. They have control over it as far as taxes go, but as far as the creation of it, they can't touch it. As far as how it gets traded, they can limit that, and they've done that some, but we're in such a world now that the black market exists online, and it will be hard to stop the transfer of Bitcoin. Extremely difficult. It can be tracked. They have tracked it for illegal purposes. People who've used it for illegal purposes, so we know it can be tracked, but it does give you some anonymity. One of the greatest cases for cryptocurrency was after the fall of Afghanistan. A CEO of a business, a woman-owned business in Afghanistan, you can imagine when the Taliban took back over, it didn't go well for her. She bugged out. But when she did that, she was going to leave everything behind. It means she lost everything. But what she'd been doing with her employees, she'd been paying them in crypto for years. And when she left the country, she had a single strip of paper that had some random letters written on it, and she tucked it in her Quran, and she walked across the border. And they checked her, and all she had was a Quran with a bookmark in it. And she walked on across. And when she got back over into a safe country, she logged back in, and she transferred her wallet back to that country. And she had her money. That's what crypto allowed her to do. Her case and her employees' case, it saved them because women couldn't have bank accounts. That was the other thing. But the online world we live in, you can do almost anything. Again, not an investment, but it is a thing that's out there. Options investing. So options you're getting wild and crazy. Somebody starts talking to you about options investing. it's probably want to say no, unless you really, really, really trust that person. And I really trust me, and I ain't doing options. Options is where I'm buying stock that I don't have, and I'm buying stock that doesn't exist and selling stock that I don't have. That's basically what I'm doing there, in hopes that the market is going to go the right direction for me so I can buy it to make good on my debt. I'm going to pay you Thursday or Tuesday for a hamburger today kind of thing. And then I hope that the price of hamburgers drops when I go to buy the hamburger. GameStop is a perfect example of why this can bite you and bite you hard. GameStop was a video game rental company, sales company, and their stock was trading in around the neighborhood of $2 to $3 a share. And a bunch of guys on Reddit, there's a Wall Street Bets, I believe is the name of the Reddit page, they got on there and they happened to notice that there was more stock that was being sold than actually existed. And that's what options allows you to do. And so they said, hey, because the gamble that all these hedge fund managers was playing on was that stock price would go to zero or go to very low when they had to actually make good on that sale, so they could buy, or because if it goes to zero, you're selling 100 shares at $0. Okay, I don't care. So they found that there was so much more stock being sold than actually existed, and so a bunch of these guys got on here and they started pumping the price of GameStop stock up, and they told everybody what's going on. And they ran that price to over $400 a share. There were businesses that went under. There were guys that they lost everything. Hedge funds that they lost clients because their clients said, what just happened? Because when those contracts came due, they may have shorted, said they shorted, 200,000 shares of stock at, $2 a share is what they were thinking. They were paying now 200,000 shares of stock at $400. That's what they had to pay out. It hurt hard. GameStop stock, it saved GameStop. They are morphing into a new company, and it actually gave them a new lease on life, and it's a crazy deal. But that is the danger of options investing, okay? It could go seriously wrong. And that's what happened when hubris got in the way. These guys thought they knew best. They were going to play the game, meaning the hedge fund managers, and that they had the corner on the market, and then a bunch of guys on Reddit destroyed them. So it's risky and it can be dangerous. Margin investing, that's just I'm borrowing money to invest. Well, no, I'm not borrowing money for my car. I'm not going to borrow money for my stock. So it's a bad idea. Collectibles. What about all my collectibles? Most collectibles are a hobby. You're not going to sell them. So they can't be an investment. That's not the case. If you are buying and selling a collectible item, that's called a business. So that's a wholly different category. Likewise, something with precious metals. Again, gold, it's there. It can't be necessarily inflated. It exists. If you want to have gold and silver, awesome, go for it. But I will not call that an investment. An investment is designed to increase in price. Precious metals may or may not, okay? Not a bad thing to have as a backup, but I would not call it an investment there. Ecclesiastes 11:1 and 2, ship your grain across the sea, and after many days you may receive a return. Invest in 7 ventures, yes, and 8. You do not know what disaster may come upon the land. That's NIV renders that. It's typically applied to the idea of a diversification with investing. Having a mutual fund is not diversification directly because your mutual fund is investing in typically stocks. So that is one category of investments is the stock market. Because most stocks are going to go down if the stock market goes down. In 2008, when the market crashed, I imagine most stocks also crashed. 9/11, most stocks crashed. So if you're diversifying everything into stock, that would not be diversification. So multiple investment mechanisms. So that's where, your fixed income products, stock, real estate, those kinds of things. That's more of the idea of investment in that. So how do you actually invest? So there is DIY. Be careful doing your own thing, though. You need to understand the investment and what you're doing. You get yourself into some serious trouble based on taxes and other things if you're not sure what's happening there. Most of these places let you do stuff you're not supposed to. And they might warn you, but they may not. So places you can do it, TD Ameritrade, E-Trade, Ally Bank, Fidelity, all these are brokerage houses. They allow anybody to sign up. Most of them now have free trades, so you can get in there and make your own trades. It's not an endorsement of any of those. It's just some of the big names that are in the business or now allowing you to do that. There's some app-only based brokerage sites. I think there's like Robinhood is one of them. Make sure these places are actually legit, because I can make an app for anything. And you're giving them your bank account information. So you want to make sure you know who you just gave access to your bank account, okay? So make sure it's legit and make sure it's real on that. The new big hip thing is AI investing. If you log into your bank, most big commercial banks are going to pop up with a link. You can invest in us. Use the power of AI for investing. Maybe it's going to be good. I don't know. But remember, it can fail, and you're trusting a chunk of code that somebody wrote out there. You can't go interview that piece of code. You can't interview the guy who wrote it even. So you don't know what's going on with that. Watch out for fees on that, brokerage fees. They're going to charge you money to keep your stock. Some of them will, some of them won't. Some will charge you per transaction. Some of them just charge you a set fee. And right now the big thing is because somebody went free trades and everybody else decided they need to go free trades to match. And so they did that. So keep an eye on that. The alternative to that is professional advisor. If you don't feel comfortable doing it, then let somebody else do that for you who's smarter or who has more experience doing this. But interview them. You want to know what their philosophy is and what their fee structures are, okay? Because if you interview them and you find out that they think that 3% return is a great investment, that you can get that at the bank, you know, and you don't have the risk. So make sure you're understanding their philosophy thing. Likewise, if they say, heck yeah, we're going to put all your money in penny stocks, I don't know. That doesn't sound very smart to me either. So interview them. Find out what their philosophy on investing is. Find out why do they recommend the ones they recommend. That also factors into the fee structure. So there's two routes. You can go the fiduciary. Fiduciary is typically what they're doing is they're going to charge you a set rate for your entire investment package, okay? So everything you're going to do is one price, a percentage of that. A fiduciary, the theory behind that is they are legally bound to do things in your best interest, not theirs. The opposite of that one is the sales commission route, and that says that when I buy a share of a particular fund, they're going to charge me, 5% of that price as a sales commission, and then that goes to whoever sold me the stock. At face value, you're like, man, that 1.5%, that sounds, they're fiduciary. They're guaranteed to do what's in my best interest. Well, that's what the law intends, whether that really happens or not. The other thing is they're getting a flat fee whether your stock goes up or down. They get the 1.5%. And if they got big accounts, do they really need your stock to go up that much? As long as you got some money there, they're making money regardless. I don't see anything negative about fiduciary. That is one route. The sales commission route is you're paying them up front. Okay? I know what I'm getting into when I get started, and that's it. I don't pay it again. I might pay a sales when I sell. There may be a sales fee that goes with that. But again, I'm going to know that up front. So there's nothing mixed in there. And if my investment goes way up, sweet. Benefit to me. The fiduciary, benefit to everybody, in theory, on that. So find out how it works. The law changed a few years ago where everybody pretty much had to go become a fiduciary, and there's all kinds of paperwork if you didn't want to go that route. I had some stuff already set up. I was like, I really don't want to change things over. This is stupid. So I literally had to write a letter saying that I understand that what I'm doing is a stupid decision. Pretty much what I wrote on the letter. And then it had to be filed because when the government came in and audited them, they were like, that account's not set up as a fiduciary. Yeah, he said he didn't want to. He knows it's stupid, but he wouldn't do it anyway. And I'm like, dude, to me it didn't matter because I just wanted to pay the fee up front and be done with it. Some other stuff is fiduciary. So it's a matter of what works best for you. And the other thing is what the advisor's going to do. Another alternative is you can use Dave Ramsey. He has a referral system. But again, regardless of whether that or not, because you're just taking somebody that is advertising with Dave Ramsey. That's what that is. They say they're adhering to his principles. But interview them. Find out exactly what you're dealing with on that. Resources. Investopedia.com, Bankrate.com, Motley Fool, Fool.com. Those are three if you just want information about things. Bankrate, awesome site for looking up calculators and things like that. Reddit, I put that in there more for entertainment factors. You can look at it, but you can also learn stuff, usually from people being stupid, because they're going to post how stupid they are, and everybody's going to tell them how stupid they are, because they're like, yeah, you thought you made money today, and yeah, you didn't. And then go to the brokerage sites themselves. Fidelity, they're going to have, you can look up. I know when I was looking some of these terms up, Fidelity would pop up, and I'd look in their dictionary. So check it out. Again, the key is anytime you're investing in anything, make sure you know what you're doing. Make sure you understand what's happening there, okay? If you don't, it may not be in your best interest, okay? Any questions on all that? I know that was 100 miles an hour. Motley Fool is probably early on one of my favorite sites to read. Just 'cause I appreciated their approach to things. Very informative. And they have some web forums, people ask questions, and they're not going to treat you like an idiot, okay? Because their whole motivation behind everything is individual investments, and they want you to be able to invest on your own and know what you're doing. All right, money myth. It's too late for me. Yeah, time is definitely a factor, and it is hard to catch up with time. So the sooner you start, the better. But the good news is you can always start today. And again, I say if you're ready, because remember what we said beforehand, if you're not through, if you still got the snowball going on, if you got debt, you got any of that stuff, you know, if the emergency funds are not in place, you're not quite ready. Use that as your goal to hurry up and get there. Okay, get through that so you can start doing this stuff. And get through the fun stuff, okay? A couple of web links here, bankrate.com. You can just search for that, and you bring up investment calculator. Well, should be a clickable link. It's not. Go in there, play around with it. What's really cool is you can put in your age, when you want to retire, how much money you've started with, how much money you're going to add every month, and then what you want your rate of return to be. You know, and you can be conservative with that. You can be, you know, like, I think the market's going to give me 15%. But not, but go ahead, have fun. Plug it in and see what it does. Because what you find out, I did that, and I wish I took a screenshot of the page. But I took somebody who's making $35,000 a year, who was setting aside 15% of that, who started with $1,000. And guess what they had when they were retirement age? I said they were going to retire at 70, I think. They cleared $1 million. You know, so they didn't have much to start with, and yet they still made it. So it's not what you start with, it's the fact that you started. That's the key. And the sooner, the better, okay? There's tons of charts you can go out there and look and say, you know, the guy that started, you know, today versus the guy that starts 30 years later, and the guy that starts 30 years later is putting in, you know, 6 times as much, and he never catches the guy that started, who never touches it again. You know, so there's tons of that. Dave Ramsey has a great retirement calculator again. You can look into that. Oh, now it brings up the page on my screen, not on yours. That's fun. Exit. There we go. All right. Any questions on that? All right. Oops, that's not what I want. Sorry. Your children's children. We'll not get through all this tonight, but at least we'll kind of get started here. Proverbs 13:22 says, "A good man leaves an inheritance to his grandchildren, but the sinner's wealth is stored up for the righteous." So, what does that entail? So, I've actually heard somebody say one time that this meant that they should leave everything they have for their grandchildren, and their kids are just out of luck. Like, you do realize it's poetic. You do realize there's some metaphor and stuff built in this. It's not literal. What I will take from this is that hopefully that there's an inheritance not only just to the children, but then there's enough to spread on down to them. It's multi-generational, okay? That is what this is talking about here. And so that's what we're looking at is leaving an inheritance on that. So the first thing with that, first money myth, I don't need a will. I don't have anything, or I don't have much. Wills are for millionaires. Who needs a will? Do you got anything? You got stuff? Do you have money? Do you have family? If you can answer yes to any of those things, then guess what? You need a will. So what is a will? A last will and testimony is a legal document communicating an individual's final wishes regarding their assets. Can include explicit instructions as to how assets are to be divided, as well as how dependents are handled. Basically, when you die, who gets your stuff? Or, if you have kids, who's going to take care of your kids? And that one's extremely important. Okay? Make sure, again, so what if you don't have a will? What's going to happen if you don't have a will? Well, the state gets to decide who gets your stuff, okay? And they also get to decide where your children go, okay? And that can make things ugly, in that one because you could be setting yourself up for a potential court battle. Death is a stressful time. Don't add to the stress. Inheritance should be a blessing. Don't make it a curse. There is so many situations I find myself in the course of work of in the middle of disputes regarding when somebody dies. You know, who gets what? The number of times that the frantic phone call of, we found a safe, we can't get in it, and nobody knows where the will is. And we don't know who the power of attorney is. We don't know anything until we get the safe opened up. We hope it's in there. If not, we don't know what we're going to do. And these people are in serious, you know, they're seriously upset over this. You know, and they just had the emotion of losing somebody, and then now they got to deal with paperwork, you know, on top of that. So don't do that. If you don't have that, it goes to the court, okay? And even if you do have one, but it's not clear cut, there can be issues. Tom Carvel, he was the kind of the creator of Soft Serve Ice Cream, at least is franchising it. He died in the 90s, I believe, and as of 2018, it was still in court battles. It may still be in court now, I'm not sure. Big news back in the day was Anna Nicole Smith. Remember, she married a dude who was 60-plus years her age. He dies, you know, and she claims it was all for love. Maybe it was, maybe it wasn't. I don't know. I'm not going to make a judgment on that, but he left everything to his son, not to her, and not to his other son. And so her and, which I guess technically would be her stepson, her stepson who was 40 years her senior probably, they sued the other brother. And so we have this big lawsuit. Neither one of them outlived the lawsuit, but I think the lawsuit is still technically pending because now you have the estate of the estate of the estate suing the estate. It's a mess. Jimi Hendrix, his dad had to sue for his estate, and then he had to sue his other son to keep him out of the estate. And it's a mess. It's ugly. And you're just dragging people's names through the mud, through the court system. Don't do that. Because the other thing is, if it isn't writing, it never happened. Because so much of this, well, Mama told me this. Daddy said this. Well, I know that they wrote this down one time, and I just can't find the paper. If it's not there, it doesn't happen. It doesn't exist. So make sure, do the responsible thing. Make sure, you know, and the other thing is communicate this. One thing, and it sounds somewhat morbid to do, but you got to keep it in mind, you got to think about it, is have a family estate meeting. You know, get all the family together and sit down and say, okay, guys, look, someday going to happen. Hopefully not for a long, 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 long time, but someday I'm going to pass. And when I do, this is how things are going to go. Okay? Here's where the will is. Here's a copy of the will. You know, you want to do that. I don't know why you would want to make it a surprise. It's not like, you know, everybody sitting around at Christmas popping open a Christmas present. You know, sit down and say, look, this is where all this stuff is. Here's my little bucket of all the financial stuff, you know, we keep. It's in the safe. Oh, by the way, here's the combination of the safe. Something happens to me. You know, you can still get in and get all that information. Have those meetings so everybody's on the same page. Because otherwise, they can be an ugly, ugly fight. And use wisdom in that. Maybe there's situations in families that you got bad management, people aren't going to manage it well. I know some situations people set up trust, you know, like that after they die, that the money can only be divvied out. Part of me says, look, they're grown people. You know, you don't need to be micromanaging your 60-year-old kids' lives if you're gone. If they want to blow it, you can't fix that today. You know, that ship sailed a long time ago. Huh? It's too late. Yeah, that ship done sailed. You know, so is it going to cause a problem? You know, because that's the other thing is you want this to be a blessing, not a curse. Okay, for everybody involved in that. That's why some I think have got to the point of I want to die broke. There's nothing to fight over. You know. Yeah. You know. I mean, I saw at a auction one time they were fighting over 6 bottles of Grandpa's homemade brew. You know, and literally it was down to almost they're going to punch each other out to come to physical altercation because the 2 families' grandkids wanted each one. And I'm like, it's a 6-pack. You can each have 3. Come on, it's not that big of a deal. But no, that's not how it's going to work out. You know, and I don't know that you need to write down who gets Grandpa's hooch, but maybe you need to write down who gets Grandpa's hooch in the will. So, how to get one? You can do it online. That is, you know, you can do everything online now. USLegalForms.com, MullenberryLegalForms.com. Those are a couple of big ones out there. There's tons more. You can go see an attorney and talk to them. They'll happily do that for you. Some of the online stuff is cheaper. But then again, if you have an attorney you trust, you got somebody already in place, they're going to handle it. You've got to do a little more of the legwork on the other. They take care of everything. You just come in, read it, make sure it looks good, and sign it. Okay. Big thing with wills or any of that stuff. When you're doing it, also get your power of attorney, medical directives as well. You can get all that done at the same time. The medical one is a huge thing now. Who can you communicate? Who can the hospital communicate to? There's people that well, I don't want my daughter knowing why I'm in the hospital. I don't know why, but you got bigger problems if you don't want them to know anything like that. But it's legit. You laugh, but it happens all the time.
Well, I was just thinking about us. In our medical stuff, especially me, get to talking about stuff, and you got to sign this.
Mm-hmm.
They talk to
Yep.
That's great. But I turn around and glad you're on the radio, and I'll chit-chat to everybody about it.
Right. Exactly. But you're the one doing it. And so they can't. That's HIPAA and all that stuff. They can't do that. I understand it. And there's so much you get in trouble with. They're not to know anything. Well, good gosh, they're your own flesh and blood. If you can't make up when you're laying in the hospital bed sometime, then again, that ship done sailed. So make sure though you have that documentation down. Because everybody gets mad at the medical side and the medical professionals over this. They can only do what they can do. They're legally bound. If they say the wrong thing to the wrong person, then they're the ones that get sued. So they're going to make sure they follow the rules the best they can. So get that. But in all these, if you need to make a change, make sure you make the change. Okay? Make sure it's all up to date. What if family situations change? In-laws, are they included? Are they included in that? Or what if they become ex-laws? Then maybe you need to make a change on that, okay? Those are all things that factor into it. So keep an eye on all those things. Charitable annuities. A lot of your charitable annuities, I think the Children's Home will come in and they will, give you a presentation on, how if you leave them an inheritance, they will help you. And they'll draft up the stuff for you, the will and all that stuff. They can help you draft all that up. And I think they'll even do that even if you're not going to do so. It's a service that they're providing. Yes, they would like you to help them, but they will do that to help you as well. So that brings up to beneficiaries. What is a beneficiary? That's an individual or an entity that receives a benefit. Typically that benefit is going to be monetary. TOD, POD, that's two acronyms that you see a lot when it comes to beneficiaries. That stands for transfer on death or payable on death. And so that is a shortcut to including things in the will. So the estate, when you pass, everything you have is part of the estate. But if you have things set up as a TOD, that is transferred on death. That no longer is part of your estate. So that moves out. It doesn't have to go through the whole probate system at that point. So if you've got things set up right, you don't have to deal with that. And really, if you have things set up right, the will is just a formality. Okay? It pretty much just goes away. It just says that I did everything already, kind of thing. So, POD is simply payable on death. It's just depending on the type of account that does that. Beneficiary deed that works for real estate. Again, at time of death, then the beneficiaries automatically then become the owners of said property. You can have, depending on the account and how they allow it, you can list multiple beneficiaries on that. And if you list more than one, you can actually sign percentages. So you could do 50-50 for two people, or you could say, look, I like this kid more than I like that kid, so they get 70-30. I don't know. Again, don't cause a problem when you're gone. I guess you don't care at that point. I guess they can be on your grave or something. That's the worst thing to do. So you're gone, but don't cause a conflict where one doesn't need to happen. But that's also where it's important to have an asset inventory. Know what you have and go through and review those things. One of the big things that happens is when you do have a death in a family, and maybe that death was a beneficiary, is remembering to go back, I got to take them back off, okay, and make sure that you've kept things current. I know that when Dad passed, then we had to all of a sudden, it's like, oh, wait, Dad was like a beneficiary for Grandma's stuff, so we had to make sure we changed all that, take him off. Otherwise, guess what happened? Then something happened to Grandma, then that actually went back to Dad's estate, and then we had to go through probate for stuff that we didn't need to do, so we made sure that we addressed that. But there was things that you're like, I almost forgot about that one, So make sure that's why it's important to have that asset inventory we talked about from the very beginning, where everything is, what all you got. And the last thing is, there any assets that are left to minors, they will be held in a custodial account, and we will talk more about that. So, but we are right at 7. So you got your review sheet from session 6. We'll run over that real quick. So it's going to be a bigger review because that was 2 weeks ago now to remember everything. But what is a net worth millionaire? How do we define that? How do we calculate that? Greater than $1 million. Yep, exactly. So we don't care if it's cash, or if it's real estate, or it's your house, or whatever. True or false? Millionaires inherited their wealth. False, yeah. 21% inherited something, but only 3% made them significant amounts. Top 3 millionaire professions. Number 1, engineer. Number 2, and number 3, the shocker of all things, is teacher. Yeah. Blow your mind, but it is. And remember what I said about if you had 35,000, you're only putting away 15%. You'd hit that well before retirement age. Investing versus savings versus speculation. What do we know about that? What's some goals in that? Yeah, some low risk versus higher risk. The return rates. Investing is more long-term. Savings is more shorter-term, or it's money that I know I might need in the short term. That would be like our emergency funds, that kind of stuff. They're going to be savings. We're not going to invest our emergency fund. I'm going to keep that in a money market, something like that, or a savings account. Investing, again, we're looking at long-term. Investing is the expectation of a return, and speculation is to an extent somewhat gambling. That's the get-rich-quick kind of mentality there. That's the day trader. We're going to short GameStop stock. And the other side of the speculation is we're going to run the price up to $400 and hope we can jump out in time. Because a lot of those guys got burned too. Because they bought in at $300 and it went to $400 and they didn't sell it until it dropped to $200, and now you're out $100 a share. 401k is a employer-sponsored plan for contributions made by the employee and possibly matched by the employer. Yeah. 403b is a retirement program for nonprofits. Yep. RMD. Yep. What type of IRA are pre-tax, tax-deferred? Traditional, yeah. And which ones are post-tax, tax-free growth? Roth, yeah. And for 2023, that limit is $6,500. And if you are over the age of 50, you get catch-up of? Yeah. Get to throw an extra $1,000 at that. Income for tax purposes is defined as what? Remember? It's money earned. It's money you did something for. Yeah. So it's not. You can't take returns from investments. That doesn't count. If you own real estate and it's just owned as yourself, you don't get to claim that as income either. On that aspect, if it's owned through a LLC, limited liability corporation, or another type of corporation, limited liability company, in a corporation, then you can claim that as income. But there's some tax things on that. In general, the higher the return, the higher the risk factor. Yeah, exactly. True or false? There's no such thing as an absolute guaranteed investment. True, yeah. Even if you say it's insured by the federal government. Yep, and there is weird stuff that can happen. It's insured, but it's insured by the government, and if the government disappears, I'm not saying there's any expectation of that, but if it were to happen, granted, your investments are the least of your concerns at that point, probably. Money markets and savings accounts are limited to 6 transactions per month. Yep. You blank lose your principal if you break a bank CD. You can, yeah. Most of them will not, but read the rules on that. What are bonds, basically? Yeah, it's loans to the government or corporations or, government entities, yeah. It's debt obligations that you're going to get returned from. Usually lower returns on that. Annuity is a contract agreement between the issuer and the owner to provide for the annuitant. Yeah, lots of words in there. And note that it's the issuer and the owner. You can own an annuity for somebody that you're not the beneficiary for. that you are not the annuitant. So that can happen. And that would be like your charitable annuities. They're the owner of it, and you're getting the income stream. So, kind of thing. Stocks, a security that represents ownership of a fraction of the issuing corporation. Yeah, you'll be a little owner of a company. Stocks are typically traded on, stock exchange or exchange markets. And value stocks typically pay dividends. Growth stocks typically don't pay. Yeah, it doesn't pay. Don't pay. Yeah, they're typically not dividend payers. And dividends are a portion of a company's earnings that they distribute back to shareholders. Yeah, so they're rewarding you for investing and putting your trust and your money in their account. They reward you back. And if we're going to reinvest those dividends, if the company allows that, or the stock, the brokerage firm allows that, that is called a DRIP. Yep. Correlating with a DRIP is there is some other things called a direct investment. Oh, I can't remember the acronym now. But where you can actually purchase stock directly through that company. There's Computershare.com. It's not a brokerage house, but they are a financial middleman, if you want to put it that way, where you can actually buy stock directly with these companies. So companies like Coca-Cola, Walmart, usually your big old companies, you can actually just buy it directly with them. You don't have to go to a broker to do that. And they'll have on there that they're DRIP accounts or not DRIP accounts. So the tax pay form you get when you get a dividend or interest is a 1099. Yeah. Get excited about 1099s, but you also know you're going to pay taxes on them. But it's okay to be excited about that. As my accountant once told me, he said, "Well, I got good news and bad news. Good news is you made more money. The bad news is you owe more taxes." I said, "So it's a give and take." I'm like, "Yeah." So we get 1099. You made money if you get 1099. You can pay some taxes on it, but it's okay. Mutual funds are a basket of stocks and bonds. Yeah. Capital gains are profits earned, and I put form. It should be from the sale of capital assets. Yeah. One thing you can actually get now, you can get some mutual funds and ETFs that even play in cryptocurrency if you really want to go down that road. So you're not really getting into it directly, but maybe on the side angle of it. 3 things to consider before purchasing a mutual fund. Yeah. Expense ratio. And the 4th one, I don't know that I mentioned management longevity. I don't think I mentioned that. That's another one there. If they've had managers that have been consistent there for 10 plus years, that's a good sign. That says, hey, this is solid. If you see that that all the fund managers have only been there for 2 years, you got a very young group of managers. Maybe check their history, check their biography. Maybe they're new as far as experience. Maybe they're not just new to the fund. Maybe they're new to the market. And maybe they're not maybe that's not the route you want to go. So look into that. See how long the management's been part of the company there. ETF, exchange traded fund. Yeah, mutual fund you trade like stock. And there were some fringe products. Yep. Yep, margin. Yep. Collectibles, precious metals. Yeah. And all of those things, you can probably find a fund that invests in those things. There's a fund you can buy. When you start getting into the physical assets, that's like commodities and things like that. I didn't even mention commodities, but you can buy funds that invest in commodities and things such as like the price of oranges. That's a big market mover, the price of oranges. Who'd have thunk, right? But you can buy, this fund, and it tries to match the price of oranges on the fund, if you so felt inclined to do that. But again, check the fees on that. Same with a lot of your collectibles investments have a lot of fees tied to them, and they also have some weird tax ramifications from them too. Because they're considered collectibles, you pay a higher tax rate as a capital gain. It's not taxed at the capital gains rate. It is taxed at the collectibles antiques rate, which is higher. So be cautious with collectibles, okay, on that one. Any questions over anything we've gone through? And we'll pick up next week with the other stuff where we left off. All right. I hope it's been informative. I hope you picked something up. Again, the idea is to be informed, and encouraged, because it's doable. No matter where you're at, if you're breathing, you can make a change, and that's the reality of things. May not be easy, but it can happen. So, and again, I'm not a financial advisor. I am not any of that. I just know some things that I picked up on myself, and made some stupid things, and fixed some stupid things, and undone some things. And so, even if it's just a question like, how do you make the budget fit together? Even if it's if you just want to ask a question, with just rough numbers, I'll be more than happy to sit down. Katie and I can more than happy to sit down and say, yeah, if we were looking at these numbers, this is what we would do. This is how we do it. So I'll be more than happy to sit down with somebody who has any questions with that. Completely generic, whatever, however far you want to go. So, all right, let's close out in prayer.
I just got a text from my sister for specific prayer needs for Niall, so if we could include this in the prayer we close tonight. The doctor originally thought the pneumonia in his lungs were gone, but they found that it's actually spreading, it's growing. So they're going to talk tomorrow about adjusting antibiotics to see if they can combat that. His body temp and blood pressure have been doing this the past couple days, and that's just concerning with like the brain swelling and things like that. They need to
Get that stabilized.
stabilize it, yep. And that the swelling will begin to decrease, that the eye can begin moving back where it needs to be. So those are her specific prayer requests she has for him right now.
And if you'll remember Gloria,
Okay.
I got a message just a while ago. Tim took me to the ER yesterday. I couldn't stand the pain any longer. I have a severely pinched nerve. He was put on prednisone for 8 days and fentanyl patch. Gave me a shot of both to the ER, feeling better today.
Okay. Definitely. All right. Anything else before we close out? All right. We'll close the prayer. Lord, we thank you for allowing us together back here this evening. Lord, we lift up those we've mentioned tonight. Lord, I pray for Niall. Lord, pray that the doctors would figure out what they need to do.